Longacres Finance here with an update to the simple allocation portfolio. The 60/40 portfolio finished the year 2020 with a 15.57 rate of return and is up 155.08% over the past decade. That's an annualized rate of return of 9.82%. The more risky 30/30/40 portfolio finished 2020 with a 21.31% rate of return and is up 176.61% over the past decade. That's an annualized rate of return of 10.71%. If you're unfamiliar with the 60/40 portfolio or its riskier 30/30/40 brother, don't worry, I will explain what both are and break them down so that you fully understand the structure, application, and benefits of each. You will get all of this information today for the small fee of clicking the like button to help promote this video in the YouTube algorithm. And since you're in the spirit of clicking buttons, why not subscribe to the channel so that you don't miss future updates? Okay, with that nonsense out of the way, let's talk about the simplest allocation structure that has historically achieved modest returns. That's right, modest returns. This portfolio isn't going to make you rich quickly, but it is a simple way to build wealth in the long term. How long it takes to grow your money to a sum large enough to retire with is different for everyone, so I won't even get into that. The main appeal of the strategy is its simplicity, and in the complex world of investing, some simplicity can always be welcome. The 60/40 portfolio is the easiest allocation structure because it simply requires that you allocate 60% of your investable assets to stocks and 40% to bonds. That's it. You never change this allocation during your lifetime and only have to rebalance your portfolio periodically. You can rebalance quarterly, annually, or use future contributions to bring the portfolio back to the target allocation. The choice is up to you. The same goes for pulling money out of your portfolio. Whether you're retired or need capital for whatever reason, you pull that capital out of your portfolio, leaving your overall allocation at the original 60/40 split. There are many critics of this investing strategy, arguing that it's not the optimal approach. And they are right. This is not the perfect investing approach. However, that is a very vague statement, because there is no one perfect investing approach for everyone. And while this strategy won't be a good fit for some, it can be ideal for others. Ultimately, you need to decide for yourself what the best approach to investing is for you. After all, you work hard for your money, and you deserve to have your money work hard for you in the best way you see fit. I believe this strategy is ideal for individuals who are looking for a simple approach to investing, have a long-term perspective, and seek a more quantifiable measure of expected return and risk. Let's break that down. A simple approach to investing means that you don't react to market events or try to time the market. You have a clear plan of how to allocate your capital with the only requirement of rebalancing your portfolio periodically. Rebalancing basically means that you bring your asset allocation back to the target allocation. Over time, your portfolio will drift off target. Stocks typically outperform bonds over long periods of time. Let me give you an example. Say you start on January 1st, investing $6,000 into stocks and $4,000 into bonds. That is a nice 60/40 split between stocks and bonds. After a few months, when you look at your portfolio, it has a balance of $7,000 in stocks and $4,500 in bonds. That is a 60.87 current allocation to stocks and 39.13 current allocation to bonds. In this case, you would need to either transfer 0.87 of the portfolio, or $100, from stocks to bonds, or add additional capital into the portfolio and allocate more to bonds to bring your overall asset allocation back to a 60/40 split. This strategy is also best suited for a long-term approach, like saving for retirement and beyond. By starting early in life, you allow more time for your money to work for you. Additionally, you can expect to see returns that are closer to long-term historical returns, since generally the stock market has more positive return years than negative return years. For example, during the past 34 years, the total US stock market had 27 positive return years and only 7 negative return years. The total US bond market had 30 positive return years and 4 negative return years. And the 60/40 portfolio had 27 positive return years and 7 negative return years. While historical returns aren't indicative of future returns, barring any cataclysmic events that would destroy the global economy, you can count on past long-term trends repeating. Hence, if you have 20 to 30 years to invest before retirement, the odds that you will see more positive return years than negative return years are pretty good. If you don't have that much time, don't worry. During the past 34 years, the 60/40 portfolio had no negative return 5-year consecutive periods. That means if you invested for any consecutive 5-year period using this approach, you would have grown your investment. And the worst 5-year return you would have achieved was 7.27%. While that isn't anything to write home about, it's still significantly better than losing money. Looking at the same analysis of the total US stock market, there were 3 5-year periods that resulted in negative overall returns. The worst 5-year period resulted in a loss of 8.52%. If you go out further to 10-year consecutive periods, the 60/40 portfolio also had 0 negative return periods. And the worst cumulative return you would have achieved was 26.97%. The best cumulative return was 281.43%, with the average being 136.27%. The further you move out over time, the better the cumulative returns look. The worst 15-year period had a cumulative return of 126.71%, and the worst 20-year period had a cumulative return of 210.35%. While those are not even modest returns, it does prove that even if you are so unlucky as to invest during the worst 20-year period during the past 34 years, your initial investment would still triple with this approach. This is also just the cumulative return on an initial investment. Most investors add contributions to their portfolio over time, which means that each individual contribution will experience its own unique time period in the market. And while some will experience the worst returns, others will experience the best returns, in the end bringing you closer to the long-term average. The cumulative return for the 60/40 portfolio for the past 34 years is 1,830.19%. That equates to an annualized rate of return of 9.03%. Therefore, over a long enough period of time, an investor should expect to achieve a 9% annualized return using this strategy. A 9% return doubles your initial investment every 8 years. That means $10,000 would turn to $20,000 after 8 years, into $40,000 after 16 years, $80,000 after 24 years, $160,000 after 32 years, and $320,000 after 40 years. To me, that is an incredible growth for a small amount of effort and a whole lot of patience. I believe the best way to create this portfolio is by using Vanguard funds. You could use either their mutual funds or ETFs, depending on how much capital you intend to start with or your personal preference. If you would like to implement this strategy in your 401k account, but you don't have Vanguard funds available to you, you could find similar products from other vendors. If there is no total US stock market fund available to you, you could substitute it with an S&P 500 fund, which is fairly similar. The total US bond fund may be more difficult to substitute and may require more research on your end, since there are many different bond funds out there. If you'd like to make this approach more dynamic and try to increase your odds of getting a better return, a popular approach is to use your age to set a moving target allocation. If your risk appetite is small, subtract your current age from 100 and set that percentage as your allocation to stocks. For example, 80% stocks for a 20-year-old, 70% stocks for a 30-year-old, and so on until you work your way down to the 60/40 allocation. You could adjust the allocation every year, 5 years, 10 years. It really just depends on your personal preference and how involved you want to be. If you have a larger appetite for risk, use 120 instead of 100. So 100% stocks for a 20-year-old, 90% stocks for a 30-year-old, and so on until again you work your way down to a 60/40 portfolio. Since stocks on average offer higher returns than bonds, having a higher allocation to stocks increases your odds of getting a better return. Let's switch over to the 30-30-40 portfolio I mentioned at the beginning of this video. This is a slightly more risky approach, but one that can reward investors with a larger return over the long term. It works essentially the same way as the 60/40 portfolio. You still allocate 60% of your capital to stocks and 40% to bonds. The one difference here is that the 60% allocation to stocks is split equally between the total US stock market and large cap US growth stocks. Large cap US growth stocks historically have generated higher returns over the total US stock market over long periods of time. They are more volatile and therefore carry some additional risk through exposure to that volatility. US large cap growth funds are easily accessible through Vanguard and many other vendors. I'm going to show you the difference of each strategy by comparing them to the total US stock market. The total US stock market has had an annualized rate of return of 10.64% over the past 34 years. The 60/40 portfolio's annualized return was 9.10% over the same period, and the 30-30-40 portfolio returned 9.57% over the same period. To measure risk, I will use volatility. That basically measures the range of how much the annual returns go up or down in relation to the average long-term return. The total US stock market had a standard deviation of 16.87. The 60/40 portfolio had a standard deviation of 10.62, and the 30-30-40 portfolio had a standard deviation of 11.49% over the last 34 years. To break this down, if history repeats itself, 68% of the time you would expect the annual return of each strategy to be within plus or minus 1 standard deviation of the average. So the total US stock market would be between minus 4.84% and 28.9%. The 60/40 portfolio between minus 0.99% and 20.24%, and the 30-30-40 portfolio between minus 1.31% and 21.67%. Pretty clear pattern here. A higher standard deviation means that you can achieve a higher return, but you take the risk of a larger loss. As an investor, you want to expose your portfolio to the possibility of higher returns early on, and reduce the possibility of larger losses as you near and go into retirement. Let's compare these three portfolios against each other now. So the total US stock market gave investors an annualized return of 10.64% with a standard deviation of 16.87% during the last 34 years. The 60-40 portfolio gave investors an annualized return of 9.1% with a standard deviation of 10.62%. So the 60-40 portfolio would have given investors 85.52% of the returns of the total US stock market while exposing them to 62.94% of the risk, as measured by volatility. The 30-30-40 portfolio gave investors an annualized return of 9.57% with a standard deviation of 11.49%. So the 30-30-40 portfolio would have given investors 89.99% of the returns of the total US stock market while exposing them to 68.14% of the risk, as measured by volatility. So essentially, the 60-40 portfolio will give you 85% of the total US stock market return while taking on about 63% of the same risk. And the 30-30-40 portfolio will essentially give you 90% of the total US stock market return while taking on a little bit less than 70% of the risk. So it's just a matter of how much return you want and how much risk you want to take. In the end, the best approach to selecting an asset allocation for your portfolio is to pick one that you're comfortable with. Understand the expected returns it may give you and the risk exposure of the allocation. That's it. Thanks for watching. See you next time.